Most people believe that inflation is bad for everyone equally. The logic feels airtight. Prices rise, purchasing power falls, and everyone loses a little ground. That is a reasonable assumption, but the data consistently tells a different story. Wealth concentration tends to accelerate during inflationary periods, not stall. There is a structural reason for that, and it has very little to do with income. The assumption that inflation affects all participants equally overlooks a fundamental distinction embedded in how modern economies are constructed. There are two types of inflation operating simultaneously at all times. Consumer inflation, the kind measured by indices like the CPI, tracks the rising cost of goods and services, groceries, rent, fuel, insurance. Asset inflation tracks the rising price of income-producing assets, equities, real estate, private businesses, commodities. These two forces do not move in proportion to each other, and the direction of that imbalance is not random. When central banks respond to economic stress by expanding the money supply, newly created capital does not distribute itself evenly across the economy. It flows first toward financial markets. Institutional investors and high-net-worth individuals have established access to leveraged financial instruments, structured products, credit facilities, real estate syndications that allow them to deploy that new capital quickly into appreciating assets. The salaried professional, by contrast, experiences the same monetary expansion primarily through the consumer channel. Prices at the checkout counter rise before wages adjust, and the timing gap alone erodes real purchasing power. This brings us to the second structural layer. Debt in an inflationary environment does not behave the way intuition suggests. A fixed-rate mortgage taken at a given nominal amount becomes progressively cheaper to service in real terms as inflation persists. The nominal payment stays constant. The real cost of that payment declines. Asset owners with long-duration fixed debt are effectively having their liabilities eroded by the same inflation that is compressing the disposable income of renters and variable-rate borrowers. The asset appreciates, the debt shrinks in real value. The net result is a structural widening of the wealth gap that has nothing to do with effort or financial discipline. The third dynamic is less visible, but arguably more consequential. Income from labor is taxed at ordinary income rates in most developed economies. Returns from appreciating assets, capital gains, qualified dividends, carried interest, are taxed at preferential rates. During inflationary periods when asset prices are rising faster than wages, a larger share of total economic gain flows through tax-advantaged channels. The tax code, in effect, amplifies the structural advantage of asset ownership during the precise periods when consumer inflation is putting the most pressure on salaried households. This is not a policy accident. It reflects decades of lobbying and legislative design, but the mechanism operates the same way regardless of intent. Understanding this architecture suggests three structural shifts worth evaluating. The first is reclassifying debt strategically. Not all debt is a liability. Fixed-rate, long-duration debt on appreciating assets functions as a hedge against inflation. Professionals who reflexively prioritize debt elimination during inflationary environments may be removing a structural advantage without replacing it. The common mistake here is conflating financial comfort, the psychological relief of being debt-free, with financial optimization. The second shift involves the composition of savings. Cash and cash-equivalent savings lose real value during sustained inflation at a rate equal to or exceeding their nominal yield. The structural alternative is not speculative risk-taking. It is allocating a portion of savings toward assets whose prices are correlated with inflation: broad equity index funds, real estate investment trusts, inflation-linked securities. The mistake professionals typically make here is treating this reallocation as timing the market when the actual objective is structural repositioning regardless of short-term price movements. The third shift is the most counterintuitive. Tax efficiency during inflationary periods is not primarily about deductions, it's about the character of income. Shifting a portion of financial activity from ordinary income, which is fully exposed to both inflation and high marginal tax rates, towards capital gains or dividend income creates a compounding structural advantage over time. This requires deliberate design of financial accounts and investment vehicles. The mistake is waiting for tax season to think about tax structure when the decisions that determine tax character are made throughout the year. Financially sophisticated individuals do not evaluate inflation primarily as a threat to their purchasing power. They evaluate it as a variable that restructures the relative advantage between asset owners and wage earners. They ask not how to survive the inflationary environment, but how the environment changes the optimal structure of their balance sheet. That reframing, from protection to positioning, is the practical difference between financial stagnation and financial compounding at the structural level. If this changed how you evaluate your financial structure, consider subscribing to Unfiltered Finance.